This S-REIT is the largest one in Singapore. This REIT has delivered a total return of 6% in the first half of the year. This REIT saw the biggest institutional funds inflow of more than $100 million in 2022. Hi, I'm Frankie. Welcome back to my fuck show. The saying goes, if you want to invest overseas, start with the largest company in the market. That way, it is easier to get in and out because it will have more liquidity compared to the smaller companies. Also, it will be much easier to get updates about a big corporation than some kicik meow firm, simply because it is big. Every media channel would like to have coverage on them. With that in mind, let's talk about CapitaLand Integrated Commercial Trust, the biggest and one of the most popular REITs when investing in Singapore. CapitaLand Integrated Commercial Trust, or CICT, came about as a merger between CapitaLand More Trust, CMT, and CapitaLand Commercial Trust, CCT, back in late 2020 during the pandemic. During that time, many people were adapting to work from home culture. On top of that, many retail shops were moving to selling online as well, blurring the line between retail space, a warehouse, and an office. It was a smart move for CICT as a proactive response to changing Singapore real estate landscape. They expected tenants to shift demand for multi-purpose spaces, so they changed their focus to mixed-use precincts and integrated development to stay relevant in the property business. Having said that, even though people's preference on property had evolved, one thing for sure is that Singapore is still deeply entrenched, which is shopping mall culture, where people would go to those places to eat, play, and watch a movie, and do many other lifestyle activities there. On the other hand, let's not forget that Singapore is still a world-renowned financial and business hub, and therefore, the offices here are definitely here to stay. With CCT merged into the enlarged entity, CICT could adapt better by providing differentiation in services, amenities, technology, and offerings to adapt a hybrid of alternative workspace solutions to its tenants. Prior to the merger, CMT was predominantly a retail REIT with 2/3 of its property value tied to retail properties. At the other end of the spectrum, CCT focused on office buildings as their primary investment target, comprising 3/4 of their property value. The remainder of the property type not mentioned here are the percentage of integrated developments that both CMT and CCT had. Now that the two of them are merged together, CICT is managing a more balanced portfolio with retail, office, and integrated property, all comprising roughly 1/3 of the property value managed by them. This kind of balanced portfolio has more diverse tenants profile, ranging from hotels to financial institutions, supermarkets, and many more. Ultimately, it will help CICT to spread out its risk more evenly and hedge itself against unfavorable market cycles. And of course, merging two companies together means they can share resources, making their operation more efficient and able to return more dividends to investors. Not to mention, the merged entity will have a very much stronger balance sheet to undertake bigger investments in the future. Today, CICT has a total of 25 properties under management, 21 in Singapore, 2 in Germany, and the rest in Australia. Since more than 80% of its portfolio is in Singapore, we can safely assume that the property market condition in Singapore pretty much determines how CICT REIT will perform. Over the next 4 years, it is estimated that the new retail supply in Singapore averages approximately 0.3 million square feet, lower than the last 5-year historical annual average supply of 0.8 million square feet. That's over 62% less new retail supply in the next 4 years compared to the past. Needless to say, retail space rent could potentially go up in the future. According to the Department of Statistics in Singapore, the total retail sales seem to be quite stable, around 3 billion Sing dollar per month, whether there was COVID or not. It's just that when there was a circuit breaker, the proportion of online sales peaked and then normalized to a level higher than the pre-COVID times. I can't help but to think that CICT is so well prepared for this this. They already plan to reposition and repurpose single-use assets in line with changing real estate trends and customers' shopping preference. No matter how Singaporeans like to do their shopping, online or offline, CICT wants its tenants to utilize the retail space to make shopping experience better. In order to do well in the retail segment, the key is to retain as many tenants in the mall as possible, because CICT can't really charge retailers a lot of rent if Singapore's monthly retail sales is stable around 3 billion Sing dollar per month, as we said earlier. In fact, the retail rental has been ranging between $30 to $35 per square feet for more than 10 years already. For the record, CICT managed to rent out 96.6% of its retail space as at March 2022. That's not bad at all. We all know that Singapore is a small city-state, but being one of the world's business hub means that many multinational companies would want to set up offices in Singapore. 2020 may be a tough year for a place like Singapore, when many expats went home and the demand for office spaces dropped tremendously. But 1 year later, these offices are swamping back to Singapore, causing Grade A office rent to rise for 4 consecutive quarters. Today, the average rent for Grade A offices is about $11 per square feet. Imagine 1 year ago, you could have rented the same office space for just $10.40 only way. Over the past 5 years, the average annual net demand for office space was always slightly lower than the net supply, which probably kind of explains why CICT's office occupancy rate is only at 92.3% in Singapore as at March 2022, lower than its retail portfolio. Nonetheless, generally speaking, Singapore REITs have significantly outperformed the broader Singapore market year to date, possibly due to the reasons that we have discussed before. However, do bear in mind that with rising interest rate environment, it will pose a valuation impact on REITs, because dividend yield from REITs may look less attractive than the increasing interest rates. In some cases, REITs that are highly leveraged with debts may suffer even more as they need to service higher interest expenses going forward. For my fellow Malaysian, if your company is in need of financial assistance, well, lucky for you, we are here to share some good news. As part of Budget 2022, the government is providing financial assistance through their Permulih Government Guarantee Scheme to Malaysian SMEs and MSCs with an annual revenue of not more than 500 million ringgit. The scheme limit is 30 billion ringgit, including 2 billion ringgit for Bumiputras over a tenure of 12 years, including 12 months of moratorium. Applications are already up and running until the full utilization of the scheme. Check out the Budget 2022 website for more info and how to apply. For CICT, it has an outstanding borrowings of around 8.8 billion Sing dollars. For every 1% increase in interest rate, it is estimated that it will need to fork out extra 12.9 million Sing dollar per annum to pay for the loans. To be fair, that's just affecting 0.2 cents per unit. So that sounds quite okay to me. What do you think? That's all we have for today. #fuck.